Hi there, tax accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover Chapter 7, Corporations, Reorganizations, from Corporations, Partnerships, Estates, and Trusts, 48th edition. By the end of this chapter, you should be able to identify the general requirements of a corporate reorganization, determine the tax consequences of a corporate reorganization, explain the statutory requirements for the different types of reorganizations, describe the judicial and administrative conditions for a non-taxable corporate reorganization, apply the rules pertaining to the carryover of tax attributes in a corporate reorganization, and lastly, structure corporate reorganizations to obtain the desired tax consequences. So, in the context of federal income taxation, when you hear the word reorganization, it's essentially a change in the legal or the economic structure of a business entity. Maybe it'll be the process of combining two or more corporations into one, sort of in like a merger or acquisition. It could also be a spin-off or a split up of one large corporation into multiple separate entities. So sometimes corporations, they decide they want to engage in a reorganization. Maybe they want to improve efficiency, consolidate the functions of management, enhance operations. So no matter the outcome, a reorganization can have a significant change on the structure and appearance of a business. So as we see here, refers to any corporate restructuring that may be tax-free under what's called Section 368. So, although the term reorganization is commonly associated with a corporation in financial difficulty, for tax purposes, the term refers to any corporate restructuring that may be tax-free under Section 368. And in order to qualify as a tax-free reorganization, the corporate restructuring, it must meet not only the specific requirements of the tax code, but they also have to meet several general requirements. And these requirements include the following. One, there must be a plan of reorganization. Two, the reorganization must meet the continuity of interest and the continuity of business enterprise tests that are provided in the regulations. The judicial doctrine of having a sound business purpose must be met. And the court-imposed step transaction doctrine should not be applicable. So the term reorganization includes, there's different types of reorganizations. The tax law specifies 7 corporate restructurings or reorganizations that qualify as non-taxable exchanges. If the transaction fails to qualify as a reorganization, it will not receive the tax-free or special tax favored treatment. So therefore, if a corporation is considering a business reorganization, they have to determine in advance whether the proposed transaction is going to specifically fall within one of these 7 types. So the code states in Section 368A1 that the term reorganization, it applies to any of the following. A is for a statutory merger or consolidation. Type B is voting stock for stock exchange. Type C is voting stock for asset exchange. Type D is a divisive exchange where there's a spin-off, split off, or split up. Type E is a recapitalization. Type F, a change in identity, form, or place of organization. Type G, where there's transfers in bankruptcy or receivership proceeding. So the tax consequences in a tax-free reorganization. The tax treatment for the parties that's involved in a tax-free reorganization, it essentially parallels the treatment under the like-kind exchange, Section 1031. So these rules, they apply only to real estate and not to the exchange of stock or securities. So whenever an investor, they exchange stock in one corporation for another, then that exchange, it'll generally constitute a taxable transaction. A qualifying reorganization, however, they avoid this treatment by creating the non-taxable exchange under Section 368. So the consequence to the acquiring corporation, there's no gain or loss recognized unless it transfers other property to the target corporation as part of the transaction. So the gain, but not the loss, is going to be recognized. The basis of the property that's received for acquiring the corporation is the carryover basis plus any gain recognized by the target corporation on the reorganization. And consequences to the target corporation is that there's no gain or loss unless it retains other property received in the exchange or it distributes its property to shareholders. Other property is defined as any asset received other than stock or securities. So this is what we know in section 351 referred to as boot. Same thing, the gain, but not the loss, is going to be recognized. Next, we consider the consequences to the target or acquiring corporation shareholders. There's no gain or loss unless shareholders receive cash or other property in addition to stock. So again, boot. Cash or other property is considered boot. Gain recognized by the stockholder is the lesser of the boot received or the realized gain, and the loss recognized only in the instance when they receive solely boot and no stock. The basis of shares received has the same basis of those that have been surrendered, decreased by the fair market value of the boot received, increased by gain and or dividend income, if any is recognized in the transaction. There's no gain or loss unless the principal amount of the debt received is greater than the principal amount of the debt that has been surrendered. And if debt instruments are received and none are relinquished, in such case, gain is recognized. So we essentially see that when these tax-free reorganizations are potentially going to take place, there's a lot that the corporation needs to, factor in. What is going to be the implication, not just to the corporation, but the target or the acquiring corporation as well, in addition to the debt security holder. So with reorganizations, it definitely requires a great amount of planning and strategy. So we move on to unit 2, types of tax-free reorganization. So we start off with 1. Each of the 7 reorganizations described in the code have specific requirements that qualify a transaction for the benefit of deferred income recognition. And the first one we start off with is type A. So the type A reorganization, this is either a merger or a consolidation. So a merger is the union of 2 or more corporations, with one of the corporations retaining its corporate existing and absorbing the other. The other corporation, it ceases to exist. It's no longer. Next, we have a consolidation. So a consolidation occurs when a new corporation is recreated to take the place of 2 or more corporations. So to get a better understanding, we have this illustration. So we look at this illustration here, and again, with a merger, it's essentially the 2 companies coming together, but one entity continues to exist and the other ceases to exist. With a consolidation, a brand new corporation is started, and the other corporation entities, they are no longer. So here we have this example here, merger transaction, the acquiring stock of the other property, they transfer over the target assets. The target is absorbed by the acquiring corporation, and the target corporation ceases to exist by operation of law. And after the transaction, we have the acquiring plus the target assets, and we have the acquiring plus the former target shareholders. And then next we see with the consolidation, fly takes the place of fire and fly, which cease to exist by operation of law. So we had these 2 entities, we had fire and we had fly. They formed a brand new corporation called Firefly, and fly and fire no longer exist. So as it relates to type A, obviously with everything in life, there are advantages, but there are also disadvantages. So in this case, the type A reorganization, it allows for some flexibility in comparison to the other types of reorganizations. So with type A, or type B rather, than type C reorganizations, the acquiring stock that's transferred to the target, they don't need to be voting stock, right? That's one of the requirements for type B and type C. The acquiring corporation can transfer money or other property to the target corporation, provided that the consideration given is at least 40% of the stock. Money or other property, however, constitutes boot, and it may cause gain to be recognized by the parties involved in the reorganization. So with type A, there's no requirement that substantially all of the target's assets be transferred to the acquiring corporation as it would be in a type C. The target, they can decide to sell or dispose of the assets that it's not desired by the acquiring corporation without affecting the tax-free nature of the restructure. But again, there are some disadvantages. So the acquiring corporation must assume all of the liabilities, including liabilities that are unknown, as well as any contingent liabilities as the target as a matter of state law. In addition, each corporation that's involved in the restructuring, they must obtain the approval of the majority of its shareholders. And in almost every state, dissenting shareholders, they can require that their shares be appraised and bought back by the corporation. So meeting the demands of objecting shareholders can become so cumbersome and expensive that parties may be forced to abandon the type A reorganization. Next, we move on to type B. So in a type B reorganization, the acquiring corporation obtains control of the target in an exchange involving solely stock. So both corporations, they still survive, and a parent-subsidiary relationship is created. So in simple terms, this transaction is an exchange of the acquiring voting stock for target stock. And the voting stock, as mentioned, it must be the sole consideration, the only thing given by the acquiring corporation. This is a requirement that is strictly construed, right? Again, use of boot is precluded and gain is never recognized. The acquiring corporation, it may acquire shares from either the shareholders of the target or directly from the target. The exception to the solely for voting stock requirement when the target corporation shareholder receives a fractional share. So in such case, they may receive cash rather than fractional shares in the acquiring corporation. And here we have this illustration. So we have type B, we have the target, and then we have the shareholders. They have 80% control, the acquiring voting stock only. So the acquiring corporation becomes the parent, and target is now the subsidiary. So there's some, strict requirements as it relates to type B. In the type B reorganization, the acquiring corporation must be in control immediately after the reorganization. So control for the purpose requires owning at least 80% of all classes of the target stock. So in this regard, all 80% need not be acquired in the restructuring transaction. Any stock that was previously purchased in separate transactions, that will also count in applying toward the 80% test. And here we see any voting stock, again, must be the sole consideration given by the acquiring corporation. Again, strictly construed, must be met. So here we have this example, and it states, assume target has 100 shares outstanding. Acquiring obtains 80 shares from current target shareholders in exchange for acquiring's voting stock. Target shareholders surrenders 80 shares of Target and receive in exchange acquiring stock. Target then transfers the 80 shares to acquiring. So Target now issues 400 new shares to acquiring in exchange for acquiring's voting shares. That would leave 500 shares outstanding. So in such case, then the acquiring stock is distributed to the target shareholders. Next, we move on to type C. So in the type C reorganization, the acquiring corporation will obtain substantially all of the target's assets in exchange for the acquiring voted stock and a limited amount of other property. So the target, they must distribute all assets received in the reorganization as well as any of its own property that's retained. the target will then have to liquidate. So with that being said, a type C reorganization, it essentially consists of a voting stock for assets exchange followed by a liquidation of the target. So the exchange is tax-free for the target shareholders unless they receive assets other than acquiring stock. So we just started a depiction here. So now it states with the type C, again, in essence, it's an exchange of voting stock for assets, and then after which the target corporation is going to liquidate. It's often referred to as a stock for assets reorganization. And keep in mind, the transfer is between entities, not the shareholders. Target corporation must distribute all assets received in the reorganization as well as any of its own property that is retained. Consideration paid by the acquiring corporation, normally it'll consist only of voting stock. However, if at least 80% of the fair market value of the target corporation's gross property is acquired with voting stock, cash, or other property can be used for the remainder. Previously acquired stock will not be considered in determining the 80% criteria. So as we can see, there are some key distinctions between the various types of reorganizations because in type B, any previously acquired stock would be counted towards control. However, with type C reorganizations, as it states here, previously acquired stock will not be considered in determining the 80% criteria of the target corporation assets. There is a limitation, all right? There's a caveat, and it is as follows. Liabilities that are assumed by the acquiring corporation, they're considered other property, which is boot, if the target corporation receives any other property other than voting stock. If the liabilities assumed are likely to exceed 20% of the fair market value of the target corporation's assets acquired, then the transaction does not qualify as a type C reorganization. So again, this is something that, the corporation would need to keep in mind, because if a corporation is looking to do this stock for assets transaction, but their liabilities exceed 20% of the fair market value of the target corporate assets required, in such case, they're not going to qualify for type C. So again, goes back to proper tax planning as corporations decide to reorganize. And lastly, for type C, it says substantially all of the target corporation's assets must be transferred to the acquiring corporation. There's no statutory definition of substantially all, but to receive favorable ruling from the IRS, the target corporation must transfer at least 90% of the net asset value or 70% of the gross asset value to the acquiring corporation. All right, next we move on to type D. So with type D, this is generally a mechanism for corporate division. So the first three types of tax-free corporate reorganizations, they're designed for like a corporate combination. Type D, on the other hand, is different. Again, this is generally used to affect a corporate division called a divisive reorganization. In contrast with the other restructurings, the entity that transfers assets in a type D reorganization, they're considered the acquiring corporation, and the corporation receiving the property as the target. A type D reorganization, it could also be utilized to combine corporations. And when combining, it's the larger corporation, which is the acquiring corporation, that transfers its assets to the smaller corporation, which is the target. So sometimes this is referred to as the minnow swallowing the whale, essentially because after the restructuring, it's the smaller company that continues to exist and the larger acquiring company that's going to terminate. So an acquisitive type D reorganization, it's useful whenever the target corporation has a non-transferable license or right, and therefore they must be the entity that continues after the restructuring. In a divisive type D reorganization, so again, rather than combining, the shareholders, they may divide the corporation by transferring its assets among two or more corporations. And this could occur for lots of different reasons. Maybe there's antitrust problems, differing opinions among shareholders, product liability concerns, family tax planning. So, a divisive tax deed reorganization, this essentially allows shareholders to accomplish their goals without incurring a current income tax liability. And in a divisive reorganization, one or more corporations, called new, they're formed to receive part or all of the transferring called original corporate assets in exchange for its assets. So in a divisive type D, the corporation is divided. Again, one or more new corporations are formed to receive the assets of original. The original corporation must receive stock representing control, which is 80% of new corporation, and the stock of the new corporation is then distributed to the shareholders of the original corporation. And active businesses must be represented by both the assets transferred and the assets that are retained by original for at least 5 years before the transfer. So there's three types of divisive type D reorganizations. We have a spin-off and split off, and we also have a split up. So in a spin-off, the new corporation is formed to receive some of the original's assets in exchange for the new stock. The original shareholders, on the other hand, they'll receive the new stock without surrendering any of their original stock. The shareholders' basis in their original stock, from there, it'll be allocated between the original and the new stock based on a relative fair market value. In a spinoff, again, no stock of the original corporation is surrendered, and they allocate. A split off is similar to a spinoff, except that in a split off, the shareholders, they surrendered the original stock in exchange for the new stock, and then the stock basis is computed in the same manner as for a spinoff. Lastly, we have the split up. And in a split up, this is where two or more corporations are formed to receive substantially all of the original's assets, and the stock of each new corporation is exchanged for the original stock, and then the original liquidates. The shareholders' basis in the relinquished original stock carries over as the basis of stock as they receive in the new corporation. So with the spinoff, here we have this depiction, this illustration for the type D reorganization spinoff. Again, with the spinoff, the original shareholders, they receive new stock without having to surrender any stock in the original. For the split off, the original shareholders, they'll receive stock, but they have to surrender part of their stock in the original. And then we have the split up. So we know that some of the original assets, they're going to be transferred to new. The rest of the original assets are transferred to fresh, and stock in new and fresh is going to be transferred to the original shareholders in exchange for their original stock, and original is going to be liquidated. All right, so this is just going through a summary of the type A through type D reorganization, some of the advantages and some of the disadvantages. So for A, this again is a merger or consolidation. Some of the advantages: no requirement that consideration be voting stock, and as much as 60% of consideration given can be cash and property without tax consequences for the stock received. Cash and other property received, however, may be taxed. One of the disadvantages, or some rather of the disadvantages, is that all liabilities of target corporation, they're assumed by acquiring as a matter of law. Majority shareholder approval is needed. So therefore, in order to deal with dissenters' rights and holding shareholder meetings as required by foreign, state, or federal law may present problems, right? Majority of the shareholders, they might not want to merge. They might not want to consolidate. That presents a problem. Reorganization B, this is a voting stock for stock exchange. This is one of the advantages. Stock may be acquired from shareholders, and procedures to effect the reorganization are not complex. Some disadvantages: only voting stock of the acquiring corporation may be used. They must have 80% control of a target, and they may have a minority interest remaining in the target. For type C, which is stock for asset exchange. Some of the advantages is it's less complex than type A. There's no foreign, state, or federal tax law to follow. Cash or property consideration for 20% or less of fair market value of the property transferred is acceptable. And acquiring assumes only the target liability that it chooses, does not have to take on all of the liabilities. Some of the disadvantages: substantially all assets of the target must be transferred. Liabilities count as other property for 20% rule if any consideration other than stock and liabilities is used. The target must distribute the stock, securities, and other properties it receives in the reorganization to its shareholders. All right, next we look at D. So D, again, this is a corporate division where we have the spin-off, the split off, or the split up, and this is acquisitive. So some advantages: it permits corporate division without tax consequences if no boot is involved, and it allows smaller targets to retain its existence. Some disadvantages is that the control requirement of 50% for an acquisitive reorganization and 80% for a divisive reorganization must be met. All right, next we move on to type E, right? So type E reorganization, this is a recapitalization. This is a major change in the character as well as the amount of outstanding capital stock, securities, or paid in capital of a corporation. So the transaction is significant only for the stock or the bondholders who decide to exchange their equity or securities, because no property, stocks, or bonds are exchanged with another corporation. The Type E reorganization has no current income tax implications for the corporation. So further, any transactions in a corporation's own stock or bonds, they're not considered taxable events. So the following exchanges qualify if they want to exchange bonds for stock, stock for stock, or bonds for stock. So the corporation can exchange its common stock for preferred stock or its preferred stock for common stock tax-free. The exchange of bonds for other bonds is tax-free when the debt received has a principal amount that is not more than the surrendered debt's principal amount. Next, we move on to type F. The type F reorganization, it's merely just a change in identity, form, or place of organization, however affected. So because type F reorganizations, they involve like a slight changes to the single operating corporation, the successor is the same corporation as its predecessor. So consequently, the tax characteristics of the predecessor, they'll carry over to the successor. So whenever there's a type F reorganization, it neither jeopardizes the status of Section 1244 stock, nor does it terminate a valid S corporation election unless the termination is desired. All right, so this brings us to our last, which is type G. So bankruptcy legislation introduced these type G reorganizations. So whenever there's an acquisitive type G restructuring, substantially all of the debtor's corporation assets are transferred to an acquiring corporation in exchange for a stock and its securities. So the stock and securities, they're distributed to the senior creditors in exchange for their claims against the debtor. And in order to qualify for type G treatment, the debtor must be insolvent before the reorganization and may be in Chapter 11 bankruptcy or a similar federal or state court proceeding. So much like the other reorganizations, type G needs to meet the judicial requirements. And the debtor corporation will have its liabilities discharged. However, Section 108 allows certain income to be excluded, limited to the degree to which the corporation is insolvent. And the practical test of this reduction of tax attributes is to provide a temporary deferral of COD income. So COD stands for cancellation of debt rather than a permanent exclusion. So the attributes, they're reduced in the following order unless the corporation elects to first reduce its basis in any depreciable assets that is going to receive from the bankrupt entity. So that's our net operating losses, our NOLs, our capital loss carryovers, in addition to the basis in property. So for the excise tax on stock repurchases, so with the Inflation Reduction Act of 2022, this imposed a non-deductible excise tax on publicly traded corporations and certain U.S. subsidiaries of publicly traded corporations of 1% of the fair market value of share repurchases starting in 2023. Just keep in mind this tax, it doesn't apply to share repurchases that are made as a part of a reorganization to the extent that no current year gain is recognized by reason of the application of Section 368. So something to keep in mind. We move on to Unit 3, which covers judicial doctrines. So, in addition to the statutory requirements for reorganizations, several judicially created doctrines act as a basic requirement for tax-free treatment. So, reorganization, it must exhibit a sound business purpose. So even if the statutory reorganizations, let's say, all the requirements are followed literally, a transaction, it will not be tax-free unless it exhibits a business purpose. So the business purpose requirement, this restricts non-recognition treatment to transactions that are motivated by valid corporate rather than shareholder purposes that go beyond tax avoidance. So in some cases, shareholder and corporate purposes, they may be so closely aligned that it seems that the reorganization is motivated by one or more shareholder purposes. Hence, the corporate purpose is deemed to be the motivation for the transaction. Next, we move on to continuity of interest. So the continuity of interest, this requirement subjects to current income tax any transactions that appears to be a sale from qualifying as non-taxable reorganization. So this requirement, it provides that a reorganization, it may qualify as a non-taxable event if the shareholders have a substantially similar investment after the restructuring as before. And in order to qualify for the tax favored status, the target corporation shareholders, they must receive an equity interest in the acquiring corporation. And as it relates to type A, so as we indicated for type A, the continuity of interest is met whenever the target shareholders receive acquiring stock that's at least 40% of their prior target stock ownership. All right, and again, this is just giving us some more information about the continuity of interest test. So when calculating the 40% threshold, the fair market value of the acquiring corporation stock is determined on the business day prior to the day the contract to reorganize becomes binding. If the consideration provided to the target shareholder is fixed, if circumstances force a modification to the contract that results in a reduction in the fair market value of shares, then an increase in the fair market value of cash or other property does not preserve the continuity of interest. Next, we have the continuity of business enterprise test. And this requirement ensures that the tax-free reorganization treatment is limited to situations where the target's business operations continue in some form. Specifically, this test requires the acquiring corporation to either continue the target's historic business, which is the historic business test, or to use a significant portion of the target assets in its business, which is referred to as the asset use test. So, continuing one of the target's significant business lines satisfies the historic business test, and determining whether the acquiring corporation use of the target assets is significant is ultimately based on facts and circumstances. And that's according to Regulation 368-1. Next, we have the step transaction doctrine. This prevents taxpayers from engaging in a series of transactions for the purpose of obtaining tax benefits that are otherwise not tax effective if accomplished in a single step. So the step transaction doctrine is a problem for reorganizations for type such as type C whenever the transferring corporation has to transfer substantially all of its assets to the receiving corporation. So in such case, if the transferring corporation attempts to dispose of its unwanted assets before, then the step transaction doctrine could ruin the reorganization's tax favor. All right. The IRS, they'll view any transactions occurring within 1 year of reorganization as part of the restructuring. So again, Uncle Sam is not having that. Therefore, proper tax planning for these reorganizations is going to be key. All right. Here it says it may be an issue for type B and C reorganizations when the stock of the target is purchased by the acquiring close to the date of the reorganization transaction. So again, goes right back to planning, planning, planning. This brings us to Unit 4, which covers the tax attribute carryovers. So some target corporation tax attributes, whether it's loss carryovers, tax credits, earnings and profits deficit, they're welcomed by the successor corporation. Others, they may prove to be less desirable. So if there's any positive earnings and profits and any liabilities assumed. So attribute carryover rules, they should be considered in every corporate acquisition. They may, in fact, determine the form or the timing of the transaction. So as it relates to the allowance of carryovers, when a corporation acquires a target property, it also acquires the target's tax attributes. So Code Section 381 determines which of the target's tax benefits can be carried over to the successor. So type B, type E, and type F reorganizations, they do not fall under the Section 381 carryover rules because the original corporation remains intact and it retains its own tax attributes. As it relates to type D, where we have a divisive tax D reorganization, it's also not subjected to Section 381. In a spin-off or split off, the original entity retains its tax attributes. In a split up, the tax attributes of the original corporation disappears when it liquidates. As it relates to the net operating losses, a target's NOL is one of the beneficial tax attributes, and sometimes it's the most valuable asset that can be carried over to the acquiring corporation. So, although the NOL can be carried back to a prior account acquiring corporation tax year, but it can't be used prospectively. So, therefore, an NOL is valuable to the acquirer because it can offset their future income of the combined successor corporation. So with the NOL utilization, we have this section 382. And again, it's applied in the change year and the succeeding years when there's a more than 50% point ownership change. And ownership change takes place on the change date that either an equity structure shift or an owner shift occurs. The net operating loss can be used to the extent of the fair market value of the lost corporation stock on the change date multiplied by the federal long-term tax exempt rate. And the amount of NOL that can be used in the year of ownership change, it occurs, is limited to a percentage of the days remaining in the tax year after the change date. Next, we move on to earnings and profits. So the earnings and profits, there's positive earnings and profits of a target acquired corporation, it carries over. The earnings and profits of a deficit corporation is deemed received by the acquiring corporation as of the change date. And the deficit may be used only to offset E&P accumulated by the successor corporation after the change date. And here we have some other carryovers. So when the successor holds several types of carryovers, the limitation is applied in the following order. We have built-in capital losses, capital losses, built-in ordinary losses, and then NOLs. So this brings us to Unit 5, tax planning. And we just have one slide here where this is assessing the restructuring options because again, as we see, there are some advantages and some disadvantages to each. And the corporation wants to make sure that they are planning correctly. So reorganizations, they can be very valuable in crafting corporate tax-free restructurings. So therefore, the parties, they need to consider carefully all of the aspects of the proposed deal because they want to be able to optimize any current and future federal income tax liabilities. So it may not, be possible to achieve all the desired corporate structure by utilizing a single reorganization type. So for this reason, reorganization should not be seen as a mutually exclusive transaction. They can be combined with other tax favored transactions into a comprehensive plan. So again, tax law allows a series of tax favored transactions to be recognized as legitimate separate steps when the statutory requirements for each are met. Careful consideration of the restructuring alternatives can help preserve the desirable tax carryover attributes. So that brings us to the end of chapter 7, which covers reorganizations. So now that this lesson has ended, you should have learned to identify the general requirements of corporate reorganizations, determine the tax consequences of a corporate reorganization, explain the statutory requirements for the different types of reorganizations, delineate the judicial and administrative conditions for a non-taxable corporate reorganization, apply the rules pertaining to the carryover of tax attributes in a corporate reorganization, and lastly, structuring corporate reorganizations to obtain the desired tax consequences.